After natural gas recently witnessed this massive crash here in the end of January, we've seen the formation of this falling wedge, which we are currently seeing being invalidated with this recent breakout here out of this falling wedge. Now we've seen all of that actually coincide to a divergence between natural gas moving down and cumulative volume delta moving up. And so that actually marked this bullish aggression actually regaining some strength in the last few days. Now, in addition to that, we are currently seeing this retest of this resistance at $3.25, and we're also moving in this high value area, in this volume area, which just shows you that a lot of volume is actually currently being traded at those prices. Now, we expect to see a breakout to the upside here continuing, and why we believe that is exactly what we'll discuss in today's video here at Chronos. If you don't want to miss those videos in the future, don't hesitate to subscribe to our channel and like the video so you don't miss future videos, and also support us for our work here on YouTube. Let's first have a look at weather and then at some fundamental and macroeconomic and geopolitical developments concerning this commodity. Concerning weather, nothing has really changed so much. Concerning the North American continent, we do not have high or extremely low temperatures. It seems to be quite neutral. We do not expect to see high demand because of sudden cold or high temperatures. So we expect to see, also concerning Europe, that natural gas might not necessarily be primarily driven by weather in the next few days. We rather expect that the geopolitical tensions that we're currently seeing happening in the Middle East being a major factor. Now, concerning India, we do obviously have high temperatures here with 31, 34 degrees Celsius, but concerning China, it is quite neutral. We do not see high, we do not see extremely low temperatures, and so it really seems like that weather might not really move the needle concerning natural gas in the next few weeks. We rather expect that the current conflict in the Middle East might have a bigger impact, because the choke point here with the Strait of Hormuz is obviously really important. And as we are currently seeing this closure here with the Strait of Hormuz, that obviously is leading to supply disruptions, because around 1/5 of global liquefied natural gas actually transited the Strait of Hormuz in 2024, and it is still quite similar. And also concerning the factor that we are seeing this actually primarily coming from Qatar, which is also currently being bombed. This is obviously a quite bullish factor to keep in mind currently concerning the geopolitics. We do have the Middle East being under attack. We do see a lot of disruptions currently happening right there. And even though liquefied natural gas that moved through the Strait of Hormuz is actually to 83% shipped to the Asian markets, that is certainly also impacting the US. We are also currently seeing that the Henry Hub spot prices on the New York Mercantile Exchange are certainly also going up. But obviously we have to keep in mind that those supply disruptions may primarily actually impact the Asian markets. And so also the Indian and Bangladesh demands are obviously really high concerning natural gas coming from the Strait of Hormuz or coming from the Middle East. And so concerning those supply disruptions, we have to take that into account. We have to obviously take that into consideration. But to really understand those cycles, those natural gas price cycles that we've seen in the past, we really have to take a look at the weekly chart to really put it all together. And what we've opened up here is the gold to oil ratio, the S&P 500 normalized by the M2 money supply, and also the stochastic RSI. And you do tend to see quite interesting correlations between those indicators. The last few lows that we've seen happening here at natural gas, have actually been coinciding to recessions or certain developments concerning those ratios. For example, let's first have a look at the gold to oil ratio. We can beautifully see that those sell-offs here at natural gas actually often coincided to this gold to oil ratio moving to the upside. We've seen that happen here with the great financial crisis. We've seen slight spikes here to the upside as well. But primarily, those bigger sell-offs here have actually always been marked by massive um, price price increases or ratio increases here to the upside at this gold to oil ratio. And it obviously makes sense. In times of economic stress, you tend to see gold actually outperform oil prices, and that's exactly what this ratio is actually showing you. Now, obviously, as we are currently seeing those supply disruptions, we are currently seeing oil actually strengthening against gold. That is why we are seeing this ratio currently falling. But eventually, we at Chronos expect to see this reverse. We expect to see this downward trend go into a upwards trend, as we do see those supply disruptions being priced in, and as we do see that the economic stress is actually leading to a flight to safety sentiment, which leads gold prices actually strengthening further than oil prices. Not because gold is actually strengthening against the dollar, but also because oil prices are going to fall harder and stronger than gold is. Because, when you have a look at the S&P 500, for example, you do actually always see history repeat. And this is now not the normal S&P 500 chart, it's the S&P 500 chart when normalized against the M2 money supply. And this is actually the less delusional chart than the normal S&P chart, since it really takes into consideration the amount of money that has been printed since the last few cycles have passed. And in fact, if you're currently seeing those highs here forming out here with the S&P, and you put a trend line on it, you actually do see we're currently retesting those levels here that we've seen happening here in the bubble, in the tech bubble here in 2000 with the dot-com bubble. Now, this is obviously a really critical level and could actually signal we could see a downtrend happening just in the next few months. And now if you have a look at the stochastic RSI, this all really puts it all together, because you really see those cycles even more beautifully with this indicator. Whenever we've seen those lows here at natural gas, we've obviously also seen lows happening to the stochastic RSI. And it seems like as we're currently swapping the lows, we are currently seeing a really important level at the stochastic RSI being invalidated with this recent move to the downside here. And even though we might see a short-term bullish rally, as we've just discussed, we have to take into consideration that we are seeing those cycles here at natural gas, which obviously would suggest we do see lower prices. And now we at Chronos expect to see short-term price increases, a inflationary development concerning natural gas, because of the geopolitical tensions that we're currently still seeing actually being influencing the market. And so in the short term, we at Chronos expect to see a bullish development. However, concerning the long run, concerning the next few months, maybe even years, we expect to see a deeper structural sell-off happening here to natural gas, as we've seen it happen so many times throughout history, as we've seen history repeat over and over again. And so if you like this analysis, please make sure to subscribe to our channel and like the video, and also make sure to check out our Discord server, and don't hesitate to ask comments, to ask questions, to give us feedback on what we're doing here. Thanks for your support. It's really great what kind of community we're building up here at YouTube. Thanks for your support. See you next time. Bye bye.